Welcome to simplerstocks.com. My name is Don Kaufman. What is on the menu today? Netflix. Now, I've been watching Netflix for quite some time, and I've actually been looking for an opportunity, the contrarian that I am, the opportunity to actually develop some type of a short position inside of Netflix. Nevertheless, if you are going to develop a short position inside of Netflix, be aware we are actually discussing here a $676 product that happens to be up some $30 today. So what do I actually base the idea of a short position on Netflix upon? We can look back at, this happens to be a 9-month chart, or we can go back here as far as, if you will, 3 years. And what do you see? Nothing but upside inside of here, with Netflix again today almost touching the 700 level. Specifically, what I'm looking at in this particular case isn't so much about a chart. It isn't the fact that in the last just 2 trading days we've seen Netflix quite literally trade from the 625 level almost to $700 per share. Okay, the word overbought doesn't even necessarily apply here, not to mention the extensive volume. What I'm actually basing the idea of creating a short position on Netflix happens to be surrounding a little bit more of a quantitative view, and that is looking at some of the options pricing. If we go ahead and go into Netflix and I open up some shorter duration options, granted we're simplerstocks.com, but to get a full view of what's going on in trading, okay, I would be remiss to not talk about what's going on in the options market. If I open up the June options and you take a look at one of my information layouts here, says implied volatility. Now, this is a little out there, a little bit confusing if you're newer to options, but each unique option, okay, has a price. Granted, right? It's the price set for each unique option. The price itself on options is set via supply and demand, sometimes known as volatility. Well, we're looking at the individual implied volatility of each unique option. And if you take a look at the out of the money calls, in this particular case, I'm actually clicking directly here on the 700 calls, okay, and their implied volatility happens to be 28%, 28 and change percent. Now, that's about $25 away from where the stock price currently is. Let's go equidistant, okay, to the puts. And you would take us to the, 650 puts. So the out-of-the-money calls are actually trading for about a 28 vol, and the out-of-the-money puts are trading in the neighborhood of like a 26 vol. Now, it doesn't sound like a lot, but in the world of supply and demand, okay, when things get so crazy and stocks explode to the upside like this, okay, the skew right now literally is demand for calls is higher than puts. That means the risk in this product is actually to the upside, which is the exact opposite as if you looked at something like the S&P. Okay, and we'll just briefly, we'll go over here to the SPX just to make a quick point. You know how unusual this skew is. Let's go to the SPX and let's look at something similar in the SPX. Look at the out of the money puts in the SPX. They're about a 14 volatility versus the out of the money calls, which is like an 8 volatility. The puts, okay, have significantly more premium in them than do the calls. Netflix is actually inverted at this point. Again, the volatility skew has flipped over in some of the shorter duration expirations. This is kind of one of those nice contrarian signals that you may look for as a trader. As such, I'm looking to build a type of a short position in here. Now, a short position doesn't necessarily mean go out and sell a stock short at 675, because we all recognize that, well, in the last 2 trading days, that stock is capable of moving from, 625 all the way to 692. That would be a not a slow and painful death, but at least a faster death than we're normally used to. In this case, I would consider some type of a spread opportunity. And there's times where, again, even if you're new to options, you just have to bite the bullet and say, listen, the spread is the way to do it because I can mitigate my risk. In this case, I'm looking to buy a $10 wide spread. The market right now, well, we're live in the market here. I still have got 25 minutes to go to the close, and the market over here is $5.05 for this particular spread. And ultimately, what that breaks down to, it's about risk $500 to be able to make $500 in this particular trade. Now, granted, we're already some $15, $20 off the highs of Netflix today. It's still an opportunistic trade. Okay. Again, you don't necessarily have to use the identical strikes of the 680, 700 put spread. And again, I am buying a put spread. And why am I buying a put spread? Because I'm buying, in this case, the 680 puts. And the 680 puts, they're already in the money. They're already in the money quite substantially. And see, before I can even, click this trade, this thing has already moved 50 cents in my favor as we come closer to the close. Netflix is backing off a little bit more into the close over here. You may have to readjust the strikes, but these 680 puts, all right, they're already $6 in the money, yet the spread is only trading for $5.45. And there's absolutely, again, no time value in purchasing this trade. If you feel you need more time, don't use the June expiration. Go out, for instance, to the July expiration. All right, the cost of this trade all the way into the July expiration. The July expiration is going to buy you a little bit more time to be right, time to be wrong. 37 days, though, remaining. It's simple. If Netflix crests below 670, you're a winner. If we're above 680, you're going to lose. But you hold a position like this. You hold a position until very, very close to the expiration date, which, if you select July, is 37 days out. Thanks a lot, everybody, for joining us here at simplerstocks.com.